Hi everyone. Good morning. Good afternoon. So, in my last YouTube lecture, I had I yes now. In my last YouTube lecture, we had begun the revision of special rates of taxes, and we had discussed quite a few sections. This is the second part of that video, which talks about concessional tax rates that are applicable that are newly. When I say newly, I mean 2019 and 2020's budget. So, it's part of your CA final program. Just a small bit of information on this iconic program of Unacademy. You have live mentoring platform. You get a one-to-one interaction with the educators and you get printed books. Test series is also there. You can get your papers evaluated. On your screen right now, you're seeing the amount and the code that you have to use for getting your subscription. Chalo. So now let's try and revise these four sections. Traditionally, India's corporate tax rate has always been considered as something on the higher side compared to compared to the companies existing elsewhere in the world. Indian companies pay a lot of tax to the government. So there was a constant pressure on the government to reduce their tax reduce the tax rate for companies. So in 2019, after the budget was announced, after the budget was there was a separate law created, Taxation Laws Amendment Act and 9, in which two sections were introduced for the benefit of companies: 115BAA and 115AB. Both these sections were treated as optional. A company could opt for one of the two sections and pay tax at a reduced rate, at a slightly lesser rate of tax. Following this, in Finance Act 2020, that is the immediately next budget, two more sections were introduced: 115BAC and 115BD. BAD was introduced for cooperative societies. BAC was introduced for individuals and HUF. Yes, and these two sections were treated as optional. And so, from an examination perspective, if the examiner wants you to use to apply these sections, mention he has to specifically mention that these two sections will apply, that you have to solve the sum based on these two. If not, if nothing is mentioned, then you have to just follow the normal rates of tax that are given by the Finance Act. Of the four, it is important that a student carefully understands 115BAA, because if you understand the first section properly, 115BAA, good afternoon, beta. If you understand the first section properly, 115BAA, the second section BAB becomes very simple to grasp, and BAC and BAD are also reasonably easy to handle once the first section is clear. So it's important that a student picks up the first section properly. It's an option. Remember this, it's an option. So these things are not compulsory. 115BAA is applicable to domestic companies. No such option is allowed to foreign companies. Foreign companies, you pay tax at the rate of 40%. Basically, you pay tax as far as foreign companies are concerned. Foreign companies, you are required to pay tax as per Finance Act 2020. Domestic companies, yes, you have a small option available. So, first of all, let us try and put down on the screen What are the rates of tax applicable for a domestic company as per Finance Act 2021? When you say Finance Act 2021, it means you are talking about previous year 21-22, assessment year 22-23. Now, if you are, remember, these are rates of tax that I'm discussing only with reference to domestic companies. If your turnover 2 years ago, that means if your turnover for previous year 1920 was up to 400 crore, then today you will pay income tax at the rate of 25%. 25% of the total income computed as per the provisions of Income Tax Act. In all other cases, you do not get covered by the 400 crores criteria, you will pay tax at the rate of 30%. Traditionally, it was always 30%. Domestic companies always used to pay tax at 30%. Now it has been reduced to 25% as per the budget. This is this amount that I am talking of. This is my amount of basic tax. To this, we add surcharge. Surcharge threshold is 1 crore. If the total income exceeds 1 crore but does not exceed 10 crore, we'll pay 7% surcharge. The total income exceeds 10 crores, we'll pay a 12% surcharge. So surcharge as per budget, surcharge depends on your amount of total income. And finally, health and education cess. So health and education cess though is applicable for everybody at the rate of 4%. This will be your tax payable. These are your rates of tax as per the budget. Now, what does 115BAA say? 115BAA says that you can pay a tax of 22% of your income. So, on a plain comparison, what was 25% or 30% has become 22%. You can pay a basic tax of 22%. But then, if you opt for section 115BAA, then you will have to pay a mandatory surcharge of 10%. It is a fixed mandatory surcharge of 10%. So, does not depend on your amount of total income. Even if your total income is below 1 crore, even if your total income is above 1 crore but below 10 crores or about 10 crores, you will pay a fixed surcharge of 10% and health and education cess of 4%. And this is how you will calculate your tax. So, on a plain comparison, you may feel that basic tax rate from 25 to 30%, from 25% or 30% has come down to 22%. And surcharge, which was 7% or 12%, has come down to 10%. But the twist here, and something very important, you will calculate 22%, of course, of your total income. But when you calculate this total income is computed as per section 115BAA. And what is the significance of this? The significance is that 115BAA, when it does your tax calculation, your total income is being computed without many deductions. This is a list that a student has to remember so that he or she can solve the sums properly. Your total income, because of this provision, will be calculated slightly on the higher side. So it will be something like this, that your total income will be slightly high, but the rate of tax is 22%, which is a bit lower as compared to 25% or 30%. If you pay tax as per Finance Act 2021, then what happens is that when you pay tax as per Finance Act 2021, this total income that we are talking of, this total income is calculated, is computed in the normal fashion. Normal fashion meaning all the deductions will be allowed, all the deductions under each head of income, all the deductions from gross total income, all of them are allowed. But when you come to 115BAA, various deductions are not allowed. Example, section 32(1), clause number 2A, which is additional depreciation, not permitted. As a company, you cannot claim the benefit of additional depreciation. Only normal depreciation is permitted. Only normal depreciation can be deducted. Under section 35, we give contributions for scientific research. Those contributions for scientific research not allowed to be deducted. Deduction under section 35AD, you get a deduction of 100% of the capital expenditure incurred for specified businesses. All those capital expenditure deduction, that 100% deduction is not permitted. Deduction under section 10AA, the SEZ deduction is not allowed. No deduction is allowed under chapter 6A. Everything. Deduction on the basis of payments like contribution or donations made to political parties, ATGGB, ATGC, not permitted. Deduction based on incomes, like if I set up an infrastructure facility, I get a deduction under ATIA, or if I'm an eligible startup, I can take a deduction under ATIAC. If I'm doing a business in northeastern states, ATIE. All these deductions based on incomes, not allowed. There are three specific deductions which are allowed. ATJJAA, generation of employment. You create new jobs, you will get a deduction under ATJJAA, even if you opt for this concessional tax rate. Section 80M, intercorporate dividends. I receive dividend as a domestic company, I pay dividend, then I get a deduction under ATM. This is permitted. Deduction under ATLA. If you are a domestic company operating in IFSC, then you are allowed that deduction. So these deductions are all income based deductions, but these deductions which I have put up in green ink, they are permitted. Other than these deductions, no deduction under chapter 6A is allowed. Under the head PGBP, you get a deduction under section 33AB, tea, coffee, rubber development account. You get a deduction under 33ABA, site restoration fund. But if you opt for this concessional tax rate, then these deductions are not permitted. Your total income will be calculated without giving benefit, without giving effect to these deductions. So what will happen is your total income will get computed on a higher side. You will not be allowed to claim additional depreciation. So you will only be allowed to take a deduction of normal depreciation year. Contributions for scientific research, which will be debited to P&L account, will have to be completely disallowed. 35AD, capital expenditure for specified businesses, not permitted. So for this also, normal depreciation will be permitted. Normal depreciation will be calculated. Additional depreciation will not be allowed. 10AA SEZ profits, export oriented profits, no deduction allowed. So my total income will be computed on the higher side as compared to the budget calculation. If I pay tax according to Finance Act 2021, there are various deductions allowed. if I pay tax according to Finance Act 2021, the chapter of set off and carry forward of losses is also available to me. But if you are opting for 115BAA, then not only are these deductions not permitted, not only are they not allowed, but relating to these deductions, if you have any brought forward losses, then those brought forward losses cannot be set off and cannot be carried forward the moment I pay tax according to this section. So, this is a list of prohibited deductions. Of course, there are a few other deductions also which are prohibited. I'm just giving you a sample list which are very easy to recollect, very easy to remember. So, if you are paying tax as per this concessional section, your total income will be computed on the higher side. You cannot set off brought forward unabsorbed depreciation to the extent it contains additional depreciation. You can definitely set off brought forward unabsorbed depreciation if it pertains to the normal depreciation. So you will have to analyze your brought forward additional depreciation. Whatever is the unabsorbed depreciation pertaining to the additional component, that will have to be forgotten, that will lapse. Whatever is the brought forward unabsorbed depreciation pertaining to normal depreciation, only that will be considered. Suppose you took a deduction under 35 AD in one of the past years and it resulted into a loss. You can carry forward that loss, normally speaking, under section 73A. But the assessment year in which you decide to go for this section, whatever is the brought forward loss pertaining to specified businesses, that loss will lapse. No further carry forward permitted, no further carry forward allowed. So yes, total income gets computed slightly on the higher side. The rate of tax as per the section is 22%. But if there is any income which is chargeable to tax as per a special tax rate. Now, in our previous video, we saw that this chapter 12 has various special rates of tax applicable. For example, short-term capital gain under section 111A is taxed at 15%. Long-term capital gain under section 112A is taxed at 10% and 112 is taxed at 20%. These incomes will also be included in the total income. And in the computation of total income, there is no restriction put up for capital gains as a head or for these incomes. You can calculate capital gains in the normal manner only. In the computation of total income, this total income that I'm talking of, this income, there is no such restriction put up. So now that I'm paying tax at the rate of 22%, now that I'm paying tax at the rate of 22%, it does not mean that these incomes will be also be taxable at 22%. Nah, these rates will continue to apply. It is only the balance income which used to be taxed as per the budget rates is now going to be taxed at concessional rates. We saw yesterday that if you earn dividend income under section 115 BBD, dividend received from a foreign company, where I as an Indian company have a minimum voting power of 26%, that dividend income will be charged to tax at the rate of 15%. 15% will continue to apply. The concessional tax rate of 22% is for all those incomes which in the normal course would have been subjected to 25% tax or 30% tax, now will be subjected to 22% tax. So, special rates of tax pertaining to companies will apply. Haji, next point, MAT will not apply. Quite obvious. MAT will not apply. You cannot, in this working, you cannot say compute the tax under section 115B double A at the rate of 22%, and then you bring into account a minimum alternate tax under section 115JB, which is 15% of book profit. And then you start saying whichever is higher of the two is what you will pay. Obviously not. This type of a working will never be done. Otherwise, you are defeating the purpose of introducing 115BAA. It's like thinking like this, that the rate was 25%. We reduced it from 25 to 22. But we said, no, instead of paying 22, you will still have to pay MAT. Then there is no point in having 115BAA. That means a company which opts for 115BAA is exempted from the chapter of MAT. Then the chapter of MAT will not apply only to you. Which means what will now happen is this domestic company will have two alternatives to figure out. Either it will calculate tax as per the Finance Act, or it will calculate the minimum alternate tax that is computed as per 115JB formula, and then whichever is higher of the two will be the tax payable. This can be understood as tax payable. This is option 1. Or what I can do is option 2. Decide to pay tax under section 115BAA. But if I do that, then the chapter of MAT is not applicable, which means this is my tax payable. Now the significance of this is that if MAT ka chapter only is not applicable, then this domestic company may have brought forward MAT credit. If it decides that it wants to pay tax as per option number 1, so very easily this MAT credit set off will be possible. Of course, it will be possible as per the MAT credit ka section. But yes, it will be possible. But if by chance the company decides that I do not want to pay tax according to the Finance Act, I want to pay tax as per 115BAA, then since MAT chapter is also not applicable, it means MAT credit ka set off not possible only. Now, if MAT credit ka set off is not possible and MAT ka chapter does not apply, it means here whatever is the brought forward MAT credit will lapse. So you have to be very crystal clear here. If your client comes to you asking you for advice as to whether he should go for the second option of 115BAA, you have to ask him if he has any brought forward MAT credit. Because if he does have a brought forward MAT credit, that brought forward MAT credit will lapse. So rather than getting it lapse, you could tell the client, okay, do not avail of this 115BAA just now. Let your brought forward MAT credit get over in the form of set off. And once you have set off the full brought forward MAT credit, you can ensure that you can switch to 115BAA. In fact, this advice can be given for computation of income also. We just saw some time ago that brought forward losses relating to these deductions cannot be set off, cannot be carried forward the moment you switch to 115BAA. So you could tell your company Then let us first set off the brought forward losses. And after those brought forward losses have been fully set off, they have become zero. Now I can switch to 115BAA. This could be a small thing to keep in mind when you give an advice, when you decide to opt for this section. This option has to be exercised on or before the due date of filing return. But once the option is exercised, it cannot be withdrawn. That is why I just spoke of those things. It's not possible to withdraw this option. Na? So before switching to 115BAA, ensure that all brought forward losses are set off. Ensure that you can set off the brought forward MAT credit if you have a MAT credit. After that, you can switch to 115BAA. You can switch to 115BAA in any assessment year you want. But after that, you can't come back on your own to Finance Act rates. Then every year you have to pay tax as per 115BAA. The section has also mentioned one more thing. It has visualized, it has thought of a violation. What happens if the company violates the section? Which means we are talking about a company which has opted for 115BAA, but in the computation of total income, it has taken any of those prohibited deductions, or it has done any of those prohibited set off. And by doing this, it has finally calculated its total income. And on this, it has paid tax at the rate of 15%. Sorry, it has paid tax at the rate of 22%. Now you are opting for 115BAA, but the computation is not done according to 115BAA. This is treated as a violation. Then regular provisions of the Act will apply. It will be assumed that you have not exercised this option. You will have to pay tax according to Finance Act rates, and henceforth, this optional section will no longer be available to you for that assessment year, definitely, and subsequent assessment. Then every calculation will be done according to budget rates only. If any interest has to be calculated for that assessment year, it will be calculated according to the budget wala tax. If any penalty has to be calculated, it will be calculated according to the budget wala tax. So once you opt for BAA, voluntarily withdrawing it, not possible. And if you violate it, then budget rates of tax will apply and it will no longer be 22%. This example that I have put up here, this is a situation of violation. This happens, then you are ineligible for this section for that year and future year. This is 115BAA. As I told you, the important thing, the time consuming thing I should say, is 115BAA. Because once this section is clear in your mind, the next section will become very easy to handle. The next section says, we are talking about new manufacturing, and of course we are talking of domestic companies. But then there are two things that I have currently highlighted. Observe, I am talking about new companies. What do I mean by new companies? These companies have been incorporated within a certain time frame. They are incorporated on or after 1st of October 2019. So a student can understand that 115BAB is not applicable to existing companies. Existing domestic companies, what can they do? Existing domestic companies can use BAA. In BAA, there is no condition that the company should be incorporated on or after this date. So that means 115BAA, this section can apply to existing domestic companies also. For that matter, 115BAA does not say new companies are ineligible. does not say only new companies are eligible. So existing companies, newly incorporated companies, every domestic company can be covered by 115BAA. BAA is a more generic section. But when you come to BAB, BAB specifically says it should be new companies. Second, BAB focuses on manufacturing companies. There was no such condition for BAA. Any domestic company, whether you are into manufacturing, trading, service sector, software industry, hardware industry, any industry, domestic company is eligible. Every domestic company is eligible in BAA. In BAB, you must be specifically involved in manufacturing. Specifically, your businesses should be either you do manufacturing or you are allowed to do manufacturing plus distribution of your products. So you can manufacture and yourself sell it, or you are allowed to do manufacturing plus research relating to your products manufactured. All this is fine, but every domestic company is not covered. In fact, as you read deeper, you realize that if you do certain manufacturing activities, although they may be manufacturing in the normal sense, for BAB, these companies become ineligible. For example, if you do mining, then mining is not included here in the definition of manufacturing as required by BAB. If you do printing and publishing of books, there is a circular of CBDT which says that if you do printing of books, it will be treated as manufacturing. So when you claim additional depreciation under section 32, printing and publishing of books is included in the definition of manufacturing, normally speaking. But for BAB, if you do printing, then this section does not call it as manufacturing. So consequently, it means BAB 115 BAB will not apply. If you are converting marble into slabs, then this business is not included in the meaning of manufacturing. It could be included in the meaning of manufacturing, normally speaking. But for BAB, it is not manufacturing. That means a student is also smart enough to realize that if it's not manufacturing as per 115 BAB, then the moment I say a domestic company doing mining or printing or that entire list ineligible manufacturing activities, they cannot avail 115 BAB, but surely they can avail 115 BAA. 115 BAA option is definitely available for them. So this section that we are currently trying to revise is a very restrictive section. It is only covering newly incorporated companies. It is only covering manufacturing companies, and that too certain manufacturing activities are excluded from the section. Again, this is a section which is optional. No such option is allowed to foreign companies. It is only for domestic companies. Mandatory surcharge of 10%, health education cess of 4%. The tax is further reduced to 15%. But now something interesting to study. Huh? In 115 BAA, it was 22%. But in 115 BAB, it is further brought down to 15%. But the whole focus of this section is to ensure that this 15% is applicable to manufacturing profits only. How does the section achieve it? It says if any income is taxable as per the special rate applicable in this chapter, then such special rate will apply. We are already aware what we are talking about. We are talking about section 111A Section 112A, Section 112, Section 115B, 115BBF. You earn royalty income on a patent which is developed in India, you pay tax at 10%. Those rates will still prevail. Things to observe. If you are transferring a capital asset which is not a depreciable asset and you are earning short term capital gain on it, it is not a depreciable asset. So, example, I can be talking of land, I can be talking of debentures, I can be talking of mutual fund units which are not equity oriented, because equity oriented mutual fund units will be covered by section 111A. And I'm talking only short term, huh? Please keep in mind, I'm talking only short term. I am talking about property, but which is not part of block of assets. So I'm not talking about factory building and office buildings, but a property which is given on rent and the rent income is house property income, these type of properties. Then if you want short term capital gain, such short term capital gain will not be taxed at 15%. Nah, 15% is only meant for manufacturing profits. When you are earning short term capital gain, either it will be taxed under 111A. 111A is equity shares, units of equity oriented mutual fund, units of business trust, for which basically the rate is 15% only. Since years, on any other short term capital gain, it will be taxed at 22%. If, next point to observe, if no specific tax rate has been provided, but the income that we are talking of is not from manufacturing activity. So I'm earning an income, it's chargeable to tax under Income Tax Act, but it is not from manufacturing. Then also the tax rate will be 22% only and not 15%. Like for example, here I can take an example of short-term capital gain from a depreciable asset. Short-term capital gain from a depreciable asset. There is no specific tax rate provided for short-term capital gain on block of asset. There is no specific tax rate in the Income Tax Act. For short-term capital gain, there is only one specific section, 111. That 111 is anyways applicable here. Short-term capital gain on block of asset, normally speaking, is taxed as per budget rates. If you opt for 115BAB, you will pay tax at 22%. Short-term capital gain on depreciable asset is one example. House property income is another example. Income taxable under income from other sources like FD interest, rent income from a plot of land, all taxable at 22%. That means if special tax rate applies, if special tax rate applies, then apply the special tax rate. If no special tax rate is applicable and it is a non-manufacturing income, 22%. Short-term capital gain other than block of asset, 22%. That means only manufacturing profits are covered, and that is at the rate of 15%. Mandatory surcharge of 10%, health education cess of 4% the moment you opt for this section. Incorporated on or after 1st October 2019 should commence manufacturing on or before 31st March 2023. You have to install brand new plant and machinery only. Second hand machines are not permitted. But yes, a relaxation is given that up to 20% of your total machines, if they are old, then this old will be treated as new. If by chance this condition is not satisfied, what do I mean by condition not getting satisfied? Condition not getting satisfied means that my old machines are greater than 20% of your total machines. Then this section 115 BAB becomes not applicable. No problem. I am a domestic company. I can still switch to 115BAA as an option. The tax rate given is a rate of 15%. So a manipulation is possible where with your related parties, you can do transactions to show higher profits, higher than normal profits in this domestic company which has opted for BAB. More profits shown, more profits are shown. That implies that if I show more profits, I'm sorry, if I show more profits, I will pay tax only at 15%. No, the law says we are aware that these type of manipulations will happen. So the assessing officer has the power. The assessing officer has the power that he will figure out what is the amount of normal profits that can be earned from this transaction. The difference between normal profits and higher profits is the extra amount that you have reflected. This extra amount will be taxed at 30%. Nobody is saying that the income is exempt, huh? No. Everything is subject to tax. Only the normal profit will be taxed at 15%. So higher profits are reflected in your books of account. AO has the power to determine what is the normal profit, assuming the transaction was done at market value. What is the amount of normal profit? Then the normal profit would be taxed at 15%, and the extra profit computed, we are not going to exempt it, we are going to tax it at 30%. Computation of income, almost identical list. All those deductions will not be permitted, will not be allowed. Brought forward losses relating to those deductions will not be allowed. You will not be allowed to claim all those deductions. So your total income will definitely be computed at a slightly higher amount. 80 JJAA, 80M, 80LA will be allowed. This is a section which is applicable to new companies. If you are talking about new companies, then the question of brought forward MAT credit will never apply only. Brought forward MAT credit will apply to existing companies. Na? This is a company with, which has been just incorporated on or after October 2019. So no MAT credit available. No MAT credit, brought forward MAT credit is not there only. Huh. One thing is sure, a MAT will not apply. You will not be liable to pay MAT. Since this is a newly incorporated company, you have to exercise this option of 115B AB in your very first return of income. In your very first return of income, you have to exercise this option. Otherwise, you cannot. In the previous section 115B AA, we could have selected this section anytime we want. That is why I had suggested that first you should adjust the brought forward losses and then you can opt for BAA. But when you are going for BAB, the fact is that it's for a new company. If you want to opt for this section, you have to opt for this in your very first return of income only. If the conditions relating to a computation are violated, then these are conditions relating to computation of total income. If they are violated, then this section 115BAB becomes not applicable. But then these are the same conditions which we saw in the preceding section also. So BAA also will not apply. That means you will have to pay tax according to regular provisions, and this section will not be available for the current year and for the subsequent year. These are the two sections applicable for domestic companies. Now, last year, Finance Act 2020, 115BAC was introduced. This section that was introduced was applicable to individuals and HUF. Of course, again, this was also an option. When you talk of individuals and HUF here, 2-3 things which we can easily remember, but some distinguishing features, but easy to remember. There is a single basic exemption limit of 2,50,000 only. Only one basic exemption limit. If you pay tax as per the budget, you have 3 lakhs ka basic exemption limit for resident senior citizen. You have 5 lakhs ka basic exemption limit for resident super senior citizen who are 80 years or above. Nothing like that. Single basic exemption limit, single, of 2,50,000. This is the same for resident also, non-resident also, less than 60 years also, greater than 60 years also, greater than 80 years also. Everybody is covered here. Single basic exemption limit. Remember, there is no concept of mandatory surcharge. Surcharge and health education cess will apply as per budgets only. The only change that 115BAC is bringing about is that it is providing you concessional slab rates. But it is not making any surcharge of 10% mandatory like we saw for companies. No. Individuals HUF follow your surcharge rules the way they are given by budget. Again, if special tax rate is applicable, then special rate of tax will apply. If an individual earns lottery, has lottery winnings, 30% will apply to that lottery winnings. If you have undisclosed income as section 68, 69, you will pay 60% tax. You can't go for these concessional tax rates. Capital gains will be taxed as per their respective rates only. These rates will not apply. What are these concessional rates of tax? A single basic exemption limit of 2,50,000. Then every time there is a new slab, it is an increase of 2.5 lakhs in the slab, and there is an increase of 5%. So as per Finance Act 2021, my slab rates are 0 to 2,50,000, no tax. From 2,50,000 to 5 lakhs, you pay tax at 5%. From 5 lakhs to 10 lakhs, you directly pay tax at 20%. And any income above 10 lakhs is taxed at 30%. If I am talking about a senior citizen, then this is the same with a slight difference that the basic exemption limit is 3 lakh rupees. So 0 to 3 lakhs, no tax. 3 lakhs to 5 lakhs, 5%, 20%, 30%, income about 10 lakhs. And for somebody who is a super senior citizen, first 5 lakh is exempt. Then from 5 to 10, you would pay tax at 20%, and above 10, you would pay tax at 30%. Now you can observe in the concessional rates, 30% is applicable only if your income exceeds 15 lakhs. And instead of 5% directly jumping to 20, there is 5, 10, 15, and then 20. There is a new 25%, which is not existing in the budget. Slab rates look very attractive. On the face of it, slab rate looks very attractive. But again, the same problem arises. Computation of total income is done without giving effect to various deductions and exemptions. And here the problem is so serious that your salaries deduction, house property deduction, PGBP deduction, Chapter 6A deduction, all of them are denied. Deduction under Section 16, standard deduction, professional tax paid, not allowed. Exemptions under Section 10(5), leave travel concession, house rent allowance, 10(13)A, special allowances, 10(14), not allowed. Under the head house property, Section 24B, SOP, a deduction, not permitted. You can take a LOP deduction, you can take a DLOP deduction. Oh God, this is so embarrassing. You can take a SOP deduction. You cannot take a SOP deduction under 24B. You can take a LOP, DLOP deduction for 24B. PGBP, the same restrictions that are applicable to domestic company are equally applicable here also. The very, very The very discouraging factor, no deduction under Chapter 6A is permitted except for 80JJAA and 80CCD subsection 2. This is a major hit. This is a hit. This is one of the major reasons why this is so unpopular as a section. Very few individuals have opted for this. People invest in PPF, people invest in life insurance policies, people pay medical health insurance premium in order to take a deduction under Chapter 6A. And all those deductions under Chapter 6A are not permitted only. People take housing loans so that they can get a deduction of interest. That deduction is denied. People pay house rent allowance. I mean, they take house rent allowance from their employers so that they pay rent and they get exemption. All of this is denied. Your total income gets computed at such a high amount. Brought forward losses are also not applicable, not eligible for brought forward losses pertaining to all of this. So, brought forward house property loss cannot be set off. Brought forward PGBP loss relating to 35 AD, relating to Section 35 scientific research contributions, nothing of that is permitted. Your total income definitely gets computed on a much, much higher amount. The concept of alternate minimum tax, AMT, is not applicable. If in the past you have paid alternate minimum tax, then the brought forward credit will also lapse. So we can suggest the same thing to our clients, that first let your brought forward losses and brought forward AMT credit get set off, then you can opt for this. A very distinguishing feature. See, this is worth noting. If you do not have PGBP income, if you do not have PGBP, then this option can be exercised every year. Meaning, if you don't have PGBP income, you can switch to 115 BAC, or you can switch to Finance Act, and this can be done on a yearly basis. It means you can withdraw yourself from 115 BAC in a particular year. Next year, go to 115 BAC. The third year, also pay tax as per 115 BAC, and then fourth year, come back to Finance Act. But if you are talking about assessees having PGBP, if you are talking about assessees having PGBP, then you have to exercise the option on or before the due date of filing return, obviously. But once exercised, you are allowed to withdraw it only once in your life. Domestic companies, though, are not allowed only to withdraw in the two sections that we saw. Individuals HUF, they can withdraw, but they can withdraw only once. If you withdraw this once in your lifetime, then what will happen is 115 BAC will not apply to you for subsequent years. If you discontinue your PGBP, we are talking about an assessee who has PGBP income. Na? You opted for BAC, then you continue with BAC. Once in your lifetime, you'll be allowed to withdraw it. Achha, if you withdraw it, then 115 BAC is no longer applicable to you. It will again become applicable to you only in one situation, when you discontinue your PGBP. Because if you now discontinue PGBP, then you will fall back into this category, not having PGBP. Now you can come back to 115 BAC and still pay tax at the concessional rate. So the thing is that if you are somebody who has salary, house property, capital gains, and IFOs, these four heads, keep on switching every year, whatever is beneficial to you, no problem. You just have to ensure that you have to exercise the option on or before the due date of filing return. But if you have PGBP income, select it once, continue paying tax under 115 BAC. Once you are allowed to withdraw, if you withdraw until you do business, 115 BAC will never apply to you. Discontinue your business, then you can come back to category 1 and keep on switching every year. Same thing, mentioned in a different way also. Okay, if the conditions are violated, we have seen how it happens for companies. If the conditions get violated, regular provisions of the act will apply. For people who do not have PGBP, regular provisions will apply only for that year. But if you have PGBP, it will apply for that year also and subsequent years also. So this is your 115 BAC, unless and until the question says do not apply 115 BAC. If the question says only, then apply. Remember these slab rates. This is an easy technique to remember, that there is an increase of 2.5 lakhs and there is an increase of 5%. Try and remember this entire list of exemptions, deductions which are not permitted. If the examiner wants, he will specifically ask you to apply 115 BAC. Going to the last section, 115 BAD, applicable to resident cooperative societies. This can be very simply understood as 100% identical to 115 BAA. That's the section that we studied at the beginning. 22% tax rate, 10% mandatory surcharge, 4% health education cess. Special rates will continue to apply, not applicable, not 22% will not apply. Computed income computation without all those deductions, identical to 115 BAA. You can compare the two, you'll realize, okay, the same list is copy pasted from BAA to BAD. You will be allowed 80JJAA and 80LA. Section 80M is for domestic companies only. Section 80M is anyway not applicable to cooperative societies. Anyway not applicable to cooperative societies. So 80M is out of the picture. 80JJAA and 80LA, you are allowed to take those deductions. But other than that, Chapter 6A is prohibited. No concept of AMT, no concept of AMT credit, nothing applicable. You have to exercise this option on or before due date. Once exercised, the option cannot be withdrawn. If the conditions relating to computation are violated, then regular provisions will apply. And for the current year and for the subsequent years, this section will no longer be applicable. So this is very much identical to 115 BAA. Very much identical. So these were the four sections: concessional tax rate or new tax regime. For a detailed study, ensure that you refer to these sections. This 1 hour cut discussion was only to quickly revise small points, but small and important points which are necessary for sum solving, which are necessary to be kept in mind. Chalo, I hope this lecture was useful to you guys. Happy studying. Catch you up with more YouTube videos for revision like this. Chalo, goodbye. Take care.